All right, hey everyone, this is Kirk here again at Option Alpha, and what I want to do in this video is go through another backtest. I ran this one just today and wanted to see the results of doing a different position in EEM. So EEM is a very popular ticker that a lot of people like to trade. I like to trade it as well. And this was an interesting test. Actually, very interesting results because this thing got crushed at the end of 2020 when everything just kind of fell apart, obviously with COVID and the pandemic. This thing's strategy, at least the one that was the high performer, just got crushed and kind of got brought back down to a baseline. So here's the setup for this one, just so you can see what I did. So I tested EEM, basically took as much time as we had data set available. The trade frequency was weekly, so we looked to enter a new position every single week if there was room in the portfolio. And I used 3 different capital allocations. So this is, again, what I think is so cool about using the backtester now is the ability to test multiple allocations with the exact same strategy, kind of the fundamentals of the strategy, but using different capital. So in this case, I did 3 different allocations. One test, or the first test, was 2% of our capital per position with no max. So every time we had an opportunity to get into a position, it was 2% of the account balance at that time, and then as many contracts as we could fit in there. The next one was 5% of our account per position with a max allocation of 30%. So if we started to get sequential trades, so we started to stack up additional trades right behind each other, it would stop allocating at 30% for all total positions. The next one that we did was 5% of capital per position and stopping a total allocation of 15%. So if you wanted to say, look, I just don't want to ever allocate more than 15%, you can only do essentially 3 positions at any one time, but it would allow the portfolio and the backtester to essentially open up a spot for a position if there was something available. So that's how we did it. The strategy that we ran was a simple iron condor strategy. We shorted the 30 delta legs on either side, and then we bought the long legs at a 5 delta. So a fairly wide iron condor. In this case, the wings could have been, multiple strikes wide, depending on, where the stock was at the time. We did this 60 days to expiration. So again, we were entering a new position every week if there was an opportunity in the portfolio, if there was room, capital allocation, that we had available, but we were selling the 60-day contracts. So we went out 2 months to sell the 60-day contracts to see how those would perform. We gave it no IV rank filter, so just continuously selling. And we took profits at 75%. So this is where, again, I think that you could have a position where it enters a contract 60 days out, but it could, come in and be a profitable position after just 2 weeks or 3 weeks or half of the time period. So whenever we had a 75% profit of the initial credit received, we took the position off. We had no stop loss. And then if we never got to a 75% profit, we exited the position 5 days before expiration. Now, again, you can be pretty granular with how you do this. You can do, other time periods as well and, exit 20 days or 15 or 25 or 30 days before expiration. You can really kind of customize this as much as you want. So once we ran this back test again, these are the results that we found. It looked like, for the most part, the middle allocation here, which was the blue one, was really kind of the rock star for pretty much the entire period until we ran into a black swan event. The green one of 2% allocation per position was a pretty stable one as well, made some money, didn't lose money necessarily. Actually, none of these really lost money. They did go through some pretty decent drawdowns at some points, but overall, since we started it, they didn't really lose any money. The blue one, like I said, was really the one that just kind of took off. And, it makes sense because during this period here, and you can click on it and we can see the results, but during this period here, maybe where EEM was trading mostly sideways, I guess, or going through some sideways moves, this one really, really kind of took off and had a real good run. And it was probably because you could allocate more capital to the position. This orange one here, the orange line here, was 15% max allocation. So obviously it cut it off at some point. Still kept up, but not as much as the other one. When you look at some of the data in here, again, you can click on any of these tests and see the actual individual performance of the components themselves. The 2% of capital one did pretty well. 68% win rate. It wasn't a loser by any stretch. It did decently well. It just wasn't a lot of capital allocated. So the whole portfolio didn't do well because most of it was sitting in cash, obviously. You started to allocate more money. You still did pretty well. You still had some pretty decent win rates. You still went through a meaningful drawdown, obviously, with the blue one. the biggest drawdown being 34% from peak to trough during that time period, which was still manageable. In many cases, a lot of people, might have, cut out and cut bait on some of those, but it's still manageable. To me, this one was probably the one that seemed most appropriate generally, and that was because the drawdown was pretty manageable with 15% total allocation if you were to run the whole thing on your portfolio. Win rate was still pretty good. You still had a pretty decent profit factor. It seemed like the more consistent of the bunch. So anyways, it's interesting to see these. Again, you can go through the trades of each of the individual positions and just see kind of when it entered positions, how wide they were, how many contracts. You can see in some cases it didn't have an opportunity to enter more than one contract or multiple contracts, and then it would scale up as necessary during different periods and depending on the pricing of the contract. So pretty cool little study here. Again, just want to share some of these as we keep moving forward. There's a lot of different ways you can run, obviously, tests inside the new backtester, but I thought this one was, again, interesting. And again, just really seeing the different allocations really, kind of takes this to a different level. So hopefully you guys enjoy this. If you do, let us know. And until next time, happy trading.